Hello everyone, welcome. My name is Vikas Shukla, and in today's video of Wide Spectrum, where we cover a wide range of topics, I'm going to walk you through what could be the potential reason that the stock market is still at a reasonably high level, even though we see that the COVID-19 situation is still not very good. The GDP numbers that just came out for the second quarter is still not so good. We are 9.5% down compared to the same period a year ago. So it's hard to predict what the stock market is going to do in next week or next month or next year or so. But we can try to frame out some of the reasons why it is so. Not to say that you can predict it something, because the actions of tomorrow are not predictable. What the government is going to do, what are the factors that are going to affect the macroeconomics, and even if you could predict some of the things, it's doubly hard to predict when that will happen, and therefore it's very hard. What you could do is to prepare yourself for if it goes up or it goes down, and you have to be prepared for that with a strategy. And that's something I would be talking about in uh, some other videos. If you subscribe, you will know about that, how you can prepare for those kind of strategies. And one of those my videos that I would refer to is to a strategy that I call as buying at dip strategies. And then there's another strategy that I will be bringing about the put sell strategy, that you can make money even if the market is volatile, or could go down in future. So you have to be prepared from here onward that the stock market could stay high, or it could go low in next 6 months, 9 months, or a year or 2 year. But and you have to be prepared for that. In this video, I am going to show you what I think is a reasonable guess for why the market is still up. If you look at, this is the kind of the chart that I'm showing, the market actually responded the way we expect it to be. The market was down from somewhere around 3000 all the way down to around 2300 or 2400. I'm talking about the S&P 500 index, to all the way down to 2400, which is a substantial down, maybe all the way down like 30% down or maybe more around March 23rd. So that is the behavior we all of us know and understand. What we do not know or do not understand is that it started going up, and not only it went up, it stays there, and it has been for a while that it's staying at this level of above or around 3,000 for like a 1.5 months or so. So this is quite predictable that we had a COVID-19 situation. Everybody knows that businesses are shutting down, their profits are going to be affected, the GDP was going to go down, the unemployment was rising, and all these factors were leading to a stock market was going down. Now, at this particular point, there was an intervention from the government, the federal government, and all the institutions. They started kind of an agents of the industry, so as to say. In other words, they started to pump in the demand in the economy. And how they did, there were several measures, and the key things were that they started giving the stimulus check to the people. And what it did is that the personal income of people that actually went up during this period of after March 19th. And then they bumped up the unemployment insurance to $6 per week for everyone who was unemployed. As a result of this, the people had more money in their hand even before the COVID-19 situation arises. So that resulted in more money, more supply than there was the goods and services available at the hand. And the second important thing was that the lowering of the interest rate. So what all these things are, and then there are more money in the hands of the industry, of the businesses, that they were giving the paycheck protection, PPP, and all these things. So what we are, if you see the stocks and the shares as the commodity that someone can buy, then the amount of the number of the shares is constant, but there are more funds or more money available to buy those shares because of the people's saving rates are gone up, and industries have more money at their disposal by way of lower interest rates, and then they had to invest it somewhere, and stock is one of the avenues they could share. So that those are the things that I pointed out, is that the lower interest rate, I think that's the most dominant factor, that has almost zero interest rate. Anyone could buy and get more loans, and then could potentially invest into the stock market with the expectations of rising up. The personal income is actually has gone up, that I pointed out, with $1,200 per person personal income in the form of the Cures Act. So that is the second factor that has contributed. Personal income eventually. Okay, so we already covered that. Another important factor is the expectation of V-shaped recovery. We know that the virus is a temporary phenomena, and then at some point of time this is going to be controlled. So whatsoever person downtime is going to make up and even probably recover and go even faster after that. So this is being a temporary phenomena. People know that the industries are going to recover, and then the stock market obviously has to come back to the point where it started going down. So now this is also going to be more recently, as we see in the July month, that the virus infections went down, but it again started going up, and the mystery is the stock market still is high and it's maintaining that level, not going down. But at this point, that's the reason that we are in a risk zone, which means that if it continues to be like this, if the GDP, the goods and services, and all these things, they keep deteriorating, then there is some chance that it will at least partially correct itself to some extent, and we have to be prepared for that. So for that, I would just advise that either maybe keep some of that in cash instead of all in the stock, or maybe invest in gold or diversify yourself. Don't put all of that money into the stock there. But unfortunately, if the bonds is not an option because of the low interest rate thing. So you need to diversify or just keep cash. That could be one of my options or advice. Um, and the expectation of V-shaped recovery and the government intervention is going to be the most important factor. The government is acting more aggressively than ever before, and at a very speedy way. For example, because as the GDP data came in and it's very negative, and then the unemployment rate is again, the government is moving fast ahead with the second CARES Act, which will again pump in money in the hands of people at $1,200 per person, and then we are also seeing some other kind of interventions. All the government is trying to do it that keep the demand up, because if people have more money in the hand, they are going to spend it either in goods or services or savings or buying stocks or other things, and that will keep the demand up, and then therefore the prices. So basically it seems to me an act of a demand and supply, the money chasing the stock. There's more money available, and then the same fixed number of stocks or shares. So that being said, there is we are forming a kind of I don't know what that could be, but there is forming an uncertainty here at this point. It could stay here or it could go down, and it could go down fast, and when that period comes, none of us know, and nobody can say with certainty whether it will go, and more importantly, when it will go down. The only thing you could do is to be prepared for yourself if it goes down, and what you are going to do in that scenario. My strategy would be to stay invested at like between 25 to 50%. I would say 50%, and keep the other in hand or in your cash, and buy that at when the stock moves down, and be prepared to buy more. I hope this video is helpful for you. If you subscribe my channel, I will show you my investment portfolio and walk you through the ups and downs of my portfolio. Thanks for taking a look.